Hello and welcome to this Thursday's morning market briefing. We've got lots to talk about, but firstly, the Fed is keeping rates where they are, but despite that, they're also looking at raising rates by the end of this year, which is in contrast to what we've been expecting for quite some time. As well as that, investors within the UK slash their bets in relation to the UK's pound, as well as their bonds, and this is in relation to new inflation data, which is showing inflation coming in far below expected levels, and this is troubling economists and also causing a large sell-off. But firstly, to talk about we've got lots to talk about on the charts. With some moves to do with Brent crude oil, as well as lots of moves in relation to the US stock market, which will have a great effect on the wider markets as a whole. But as well as that, we've got lots of economic data coming out today, including the Bank of England's interest rate decision. But we'll get straight to it. So the Federal Reserve signals fresh rate rise this year and fewer cuts in 2024. Now, the Federal Reserve officials on Wednesday, so yesterday, did signal support for another rate rise this year. And this is in contrast to really what we've been expecting, what we've been talking about, with a lot of the Fed's rhetoric being largely about how rates were going to stay the same, but for longer. Now, what we've heard from yesterday's statement, as well as his press conference after, is that rates are going to be staying higher for longer, as we've thought. However, rates also may rise further, as well as rates being cut even later than expected. Now, the Fed opted against another interest rate increase yesterday, despite that. However, so this is kind of interesting because they're saying that they're looking at raising rates. However, they're also talking about how they didn't want to raise rates too soon, and this is largely in play to Jerome Powell's philosophy around raising rates, and that being that he likes to wait for data to come out to show that this is a real issue, and not just something that's come about all of a sudden. And this is kind of in relation to the fact that he wants to see whether rates that have been raised for a while now, they've been raising rates consecutively. He wants to see the effect of those rates and see whether they're being effective before raising rates further and possibly harming the US economy. Because I know prior to the last jobs release, in relation to the jobs release data, prior to that, it was seen that the US economy was being hurt by the rate increases. However, following the new employment data, it was kind of seen that, okay, the US is kind of doing better than expected, which is why, this decision is quite interesting. Now, this all comes after one of the most aggressive campaigns to stamp out inflation, and this is what we've been speaking about for quite some time now, is that the US Fed has been putting a lot of pressure on markets by raising rates consecutively, over and over and over again, putting so much pressure on business and consumer confidence. Now, in a statement, the committee said it remained highly attentive to inflation risks, and this is adding to Jerome Powell's later statement in relation to inflation and possibly raising rates. And that's their rhetoric in relation to we're still keeping an eye on what's occurring with inflation, and we're still keeping an eye on prices in relation to whether we should raise rates further. And that's interesting primarily because recently, as we've spoken about quite a lot, is the oil price jump, and that's as a result of Saudi Arabia and Russia continuing their oil supply cuts. Now, predictions for growth and inflation were also made, with the Fed predicting stronger economic growth this year and a more gentle inflation outlook. And now, the more positive and stronger US economy is kind of expected by a lot of us investors, and that's primarily because of that more recent jobs data that did come out, which showed that the US economy wasn't actually hurting that much from these rate rises. And so it's no surprise to us that they're predicting higher levels of growth, and as a result, it kind of plays into the fact that it's no surprise that they might want to raise rates further. After all, if you've got a strong economy, and you're just trying to stamp out the inflation, you're seeing that the increase in rates isn't affecting growth that much, then you're kind of free to continue raising rates. without the damaging sides of raising rates. But as a result of the meeting and the decision, the 2-year US Treasury yield, which we'll come to at the end on the charts, rose to its highest level following the Fed statement, with Jerome Powell saying in the press conference following the statement that the decision to hold rates steady did not mean policymakers had concluded monetary policy, and monetary policy was not sufficiently restrictive to bring inflation under control. So he's basically saying that rates aren't necessarily at their peak, and they're not necessarily controlling inflation as they should. Now, policymakers also submitted their 2026 forecast for the first time, predicting a year-end policy rate of between 2.75 to 3% for the US bank rate. Now, officials' median estimate for gross domestic product growth by year end increased significantly to 2.1% from 1%, and was again revised higher by 0.4 percentage points for 2024 to 1.5%. So, as we can see there, the Fed is changing its predictions in relation to the growth of the US economy and predicting a better US economy going into next year's election year. So it'd be interesting to see how, this actually does play out with Biden's re-election campaign. But I guess, the real key winner in relation to the economy and a president is whether inflation has been brought down. And with these kind of predictions, it does seem that inflation's probably going to stay higher for longer, unless these rates can really tame the inflation, whilst growth is going to increase. So let's see which one has a greater effect on the US voters' mind, which we'll see next year. Now, inflation forecasts were also adjusted, with core inflation being moved from 3.9% to 3.7%. So for core inflation, it is predicted that inflation will come down, and that's excluding food and oil prices, remember. However, we have to remember, it's the larger, inflation picture which, US consumers are going to be, seeing and voting based on, and that includes oil prices. It's just core inflation is more important to the banks, the central banks, as they're actually able to have a greater effect on that by rising or lowering rates. Now, in addition to that, the unemployment rate is now projected to reach 4.1% by 2024, a lower peak compared to June. That said, issues to do with growth have also begun to emerge, including the resumption of student loan repayments and unresolved auto worker strikes, and the looming government shutdown, which may take place as a result of an inability to agree on a government budget. But that's all for the Federal Reserve. But next to talk about is the pound, is the Bank of England, and there's certainly lots to talk about in relation to that, in relation to inflation in the UK. Now, UK investors slash bets on UK rate rise as inflation falls to 6.7%. Now, UK prices rose less than expected in August, lowering the annual rate of inflation to 6.7%. Now, this has put pressure on the Bank of England to pause its run of interest rate rises on Thursday, which is today. So we've been talking about the Bank of England's interest rate decision quite a while now. Even yesterday, we spoke about how the OECD was recommending the Bank of England to raise rates, whilst recommending the Fed to keep rates the same. So it'll be interesting to see how that recommendation will actually play into the Bank of England's mind coming into today's Bank of England interest rate decision. And inflation was predicted at 6.8%. But UK prices rose less than expected in August, lowering the annual rate of inflation to 6.7%. So when we kind of think about that, this is kind of taking it away from what the OECD was recommending, and more so saying to the Bank of England, look, you don't need to raise rates as soon as you expect, as inflation is actually starting to come down. Now, inflation was predicted at 6.8%, with the actual figure as a result causing a sell-off in the sterling as traders recalculated their expectations of interest rates. Now, swap markets are now evenly split on the prospect of a 0.25 percentage point increase this Thursday, and this is down from the figure prior to the inflation data, and that was 80% were predicting an interest rate rise. So this inflation data has had a great effect on the swap markets and what people are predicting for the Bank of England's decision. Now, the data released also caused 2-year gilts to decline by 0.14 percentage points to 4.85%, with the pound against the dollar initially falling to its lowest level since May, before recovering to price in at $1.24 as a result of the Fed's interest rate decision, which we just spoke about. So it's kind of interesting to see how these two data releases really did play out yesterday in the markets. Now, financial markets and economists were most surprised that prices rose less during the month of August this year than they did last year, even though petrol prices and diesel prices had jumped on the back of higher crude oil costs. But this was caused by a decrease in restaurant prices in the month and a much more moderate price rises in August in goods and services related to pets and recorded media. And so that's kind of going back to the situation around rising oil prices. Most economists were expecting that these rising oil prices were going to have a great effect on UK's inflation data. However, it is interesting to see how kind of these certain sectors of the UK's economy, which kind of people less factor into their expectations for inflation data, can actually cause a greater effect on the data itself than something like the rising oil prices. And a decrease in restaurant prices can cause an actual fall in inflation data, so it's quite interesting to see that. Now, the more important core inflation was also down from what economists expected, with core inflation coming in at 6.2%, which is down from 6.9% last month. This data will force the Bank of England to pause for thought in relation to whether to increase rates or not, with the expectation prior to the data release being that a 0.25 percentage rate hike was imminent, and we spoke about that with the swap markets pricing that in. Now, Chancellor Jeremy Hunt welcomed the ONS figures, but also cautioned that inflation is still high. So keep your eyes on the Bank of England's interest rate decision today. It'll have a great effect on the market, so keep your eye on that and make sure you know what's coming out from the Bank of England when you're trading the pound today. But next to talk about, and moving on from the articles, we have the charts to talk about, really, with the first sort of items to talk about being US indexes. Now, US indexes obviously have a great relevance to any rhetoric from Jerome Powell and the US Fed, and that's what we've seen today, with rates initially rising. However, not rates, sorry, with the US 30 here, initially rising after consolidating for a while, which we've spoken about, but initially rising and now dropping off dramatically as the markets start to price in the expectations of rate rises by the end of this year. And this was, the reason why it's kind of falling off a bit is because, markets had priced in rates staying the same, possibly for the whole rest of this year, and then, early rate cuts coming into the end, coming into the start of next year. And so this will have a grave effect on these US indices, as we can see with the US 30, and especially on the Nasdaq, which has dropped off, making new lows not seen since the 28th of August. So it'll be interesting to see how this rhetoric from the Fed will affect US indices. And moving on from that, to talk about is the dollar, which obviously will also be greatly affected by any rhetoric from Jerome Powell. And initially, we kind of saw this drop off as there was no interest rate hike However, following Jerome Powell's rhetoric around raising rates later in this year, we've obviously seen the dollar push for new highs, even touching, kind of breaking above prior highs, so making new highs, however returning back below. So it'll be interesting now we've heard this rhetoric from Jerome Powell around raising rates later. Raising rates by the end of this year. It'll be interesting to see whether dollar make new highs, but in my opinion, we'll see a great effect on the dollar based on the UK's Bank of England interest rate decision, and see how that'll play out on the global marketplace. And that plays straight into talking about pound dollar, which saw great effect as a result of the dollar ranging as a result of the Fed's rhetoric today. But it'll be interesting to see how pound dollar will actually play out, as it's been pushing for new lows for quite some time now, not seen since May 2023. So it'll be interesting to see how it will play out today, after we've heard the Fed's rhetoric from yesterday, and now we're going to hear from the Bank of England today. So keep your eyes on pound dollar. As well to talk about is Euro USD, which we talk about quite often, but obviously it's quite significant. And as we can see here, yesterday, as a result of the Fed's talk, meeting and decision, we saw Euro USD to initially make some gains, push into this area of liquidity, this 78.6% Fibonacci area, before rounding off and declining after the Fed gave out spoke of rhetoric which was positive for the dollar in relation to raising rates later this year. And so as a result, we kind of saw this fall off. So it'll be interesting to see now whether Euro USD will make a double bottom, or it will actually continue to break lower. But next to talk about is USD JPY, which has now broken prior highs at the triple top made there. And so it'll be interesting to see whether whether that will play out interestingly, and whether it will continue to make new highs, or in fact it will break lower. But next to talk about is gold, obviously in relation to rate rises and anything happening on the dollar. And we've seen great volatility around gold, with gold pushing for new highs and then coming back down and settling here, so just spiking and coming back down. But it'll be interesting to see how gold will obviously play out. Next to talk about is US Treasuries, with the US 2-year Treasury bond spiking in terms of its yield as bond prices fall, as the market starts to price in Jerome Powell's rhetoric around raising rates later this year, and more money moves towards the dollar and out of bonds. But next to talk about is oil, which is in an interesting spot really, as it's now retraced. And we spoke about quite a lot recently that oil was continually making new highs and seemingly never wanting to retrace and tap that liquidity, but now it has in fact begun to retrace. So it'll be interesting to see whether it will reach these areas of support around the 61.8% area on US oil, or now it's sitting in this 50% area for Brent crude oil, where it will continue to move higher or reach this 78.6% area. But that's all for the charts. Next to talk about really is the economic calendar, with the UK's public sector net borrowing data coming out tomorrow, as well as the Bank of England's interest rate decision, obviously, as well as US continuing jobless claims data coming out, along with Eurozone consumer confidence flash figures, along with the ECB's President Lagarde speech, which will be interesting to see how the ECB is kind of reacting to these decisions around the Fed and the Bank of England, as well as Aussie bank balance of trade. But that's all for this Thursday. Hope you have a great trading day. Keep your eyes on the Bank of England's rhetoric, and yeah, have a great trading day. See you later. Bye.